Traders, hope you're well. Got an amazing bank holiday special for you today. Institutional Sundays, the best way to start your week. Did over $5,000 last week, even though I only traded 3 days because it was my birthday. And finished the month off on just over $31,000 cash. So we'll talk very briefly about that, but mainly today is all about you, setting you up for the week. Absolute must-watch video, okay? Whether you're trading equities, foreign exchange, crypto, commodities, it doesn't matter. You need to know the stuff in this video. Today we're going to talk about Jackson Hole, the comments last week, crucial for the rest of this year. And we're going to talk about the PMI, the Purchasing Managers Index, also commonly known as the PMI, which came out last week, and then obviously the week ahead as well. Crucial video, and as I said, it was my birthday, only 3 days last week, still did $5,000. That's $5,000 more than anyone using technical analysis, right? Let's be honest, and you might think I'm joking. I'm actually not. I'm being very serious. I'll see you on the other side. Can't wait to start. Okay, traders, here we are. So as I said, bank holiday special because Monday is a bank holiday. And actually it was my birthday, so I didn't trade Thursday and Friday. So I am going to keep this one short. Always say it, but actually my mum's waiting for me to cut the birthday cake. So I better be on time. Yeah, you see how much value I'm providing. Even on, well, my birthday was the other day, but even with a cake to cut, I'm still here. Punching out this video, so stick around because it's going to be short and to the point. So like I said, let's get on with it. Flash PMIs on Monday. In fact, let's talk about the whole week in general. Up 1.5 to 0.2%. Another rip-roaring week, same as last week, very similar. Where Monday, obviously we had a punchy day. With last week not much data. This week we had the flash PMIs, which we're going to talk about in a second. We also had some COVID vaccine being approved by the FDA. I believe that's the Federal Drug Agency. So that was positive news. We also had some fairly good COVID case data coming out. So even though we've got to the highest point since January, you're going to see the week-on-week change. Week-on-week change was fairly positive, so there's some of that, and that really set the tone for these 3 days. Okay, that's why we hit all-time highs every single day: Monday, Tuesday, Wednesday, Thursday. Unsurprisingly, even though preliminary GDP, which is the second cut of GDP, came in revised up slightly, we still sold off ahead of obviously Powell's speech at Jackson Hole. And then Jackson Hole speech really was positive in the sense that there was some fear that he may bring forward the tapering time period. That didn't happen, which was obviously taken extremely positively, and therefore we hit all-time highs. So just to reiterate, because I do like to look at this in a slightly bigger format, and again, as always, big shout out to my former employer, Barclays Investment Bank, which is where I learnt to read a lot of this data. So, thanks to them. Just always like to obviously credit where credit is due. So just again summarize, we spoke about the first 3 days, the tone being set by, even though the headline number wasn't strong in the flash PMI, it was still in expansionary territory. We had the Delta numbers getting slightly better, which I'm going to talk about in a second. There was some talk about infrastructure, the 3.5 trillion infrastructure bill being clearing some hurdles, in the US. So that obviously was positive as well, and that really set the tone for the week. And then GDP was strong as well, but we sold off ahead of basically Fed talk. So you could say from Powell, essentially, which came in pretty bullish for the market. So let's break that down really quickly. Like I said, I've got a chocolate cake waiting for me, birthday cake. So Let's put this into perspective very, very quickly. So this year we've had 52 all-time highs, okay? Unbelievable, right? 52 all-time highs. The only other two periods, I believe, is 61, right? We're probably going to beat that now. So it's really, and in fact, 1964. So really we're on target for the 1995, 77 all-time highs in a year, okay? That's the all-time record. Can we beat that this year? Maybe. I mean, if you look at it as a kind of bracket, between 89 and 2000 with the market, obviously we saw an unbelievable rally. We had 327 all-time highs. Between 2013 and 2021, we've now broken that, 328. So no reason why 21 can't be a record year. So just something to bear in mind. Thought I'd just like to put some stats out there which are quite useful. Just a little summary of last week again. I talked about the PMIs being important on Monday. Even though this services number in particular was quite weak, we're going to talk about in a second the composite of the two. Manufacturing came in slightly under forecast, but both of these are now coming off the kind of peaks we've seen over the last 2-3 months. So PMIs are off. Is it really surprising with the case numbers up, COVID case numbers? It's not. What is actually surprising, and this is where a lot of people don't understand, who are not as experienced reading economic data or understanding markets. And this is why people who tell you can learn this business very quickly using some silly little lines are completely deluded, and people who listen to them are just as deluded. No offense. This stuff takes time and experience. You start to realize that it's not headline numbers that matter, it's context. Putting some context around this, yes, the numbers in terms of the PMI survey data index numbers, because don't forget this is a survey index that gets sent out to around, I think it's between 400 and 600 purchasing managers. So this was the flash, which is the initial estimate, which we're going to talk about in a second. Very, very leading indicator, because actually this represents August, and August is not even over yet because the survey was literally just done. The final will be coming out in another couple of weeks as more respondents come in. But the point is that the headline, okay, doesn't tell you the whole story. It's more the fact that even though cases, as we're going to look at in a second, COVID cases have been rising so much, I think everyone on the street expected these to come off more. They haven't. They're still in expansionary territory, and that's why the market is looking at them very, very positively. We didn't really have much of note Tuesday and Wednesday, as I pointed out already on the initial graph, and then Thursday, like I said, 6.6, so it actually got revised up. Do you see what I mean? Forecast was 6.7. A lot of people would look at 6.6 and say, oh, it's missed forecast, that's negative. It is not. You've got to think, what was the initial estimate of GDP? 6.5, so it's actually been forecast upwards to 6.6. Very good number. We simply sold off ahead of the main speech coming from Powell, the Jackson Hole speech, where all the central bankers meet every year. So there was a little bit of a sell-off, and then, like I said, we're going to have a look at some of his comments, which were taken very positively by the market, which led to all-time highs. So positive Tuesday, positive Wednesday, a little bit of a sell-off ahead of some risk off ahead of the speech, and then positive on Friday. Okay, so hopefully everyone's following along so far. We're going to now have a look at the PMI. So manufacturing services individually, 55 and 61. We're going to have a look at the composite, because that's also released by Market, which is the number that the company that does the survey. Okay, so here you go, Market composite PMI. Okay, so the composite is the services and manufacturing together, which we can see was off, right, quite a bit, 55.4 versus 59.9 in July, right, which was there. Again, we even had some higher numbers a couple of months back in June. But as you can see, still very much in positive territory, okay? Expansionary territory. You've got to look at the last 10, 15 years. Look, we're still very, very elevated. I've talked about this before. We can see here GDP and the PMIs, highly correlated, very leading index. We already know GDP rates are expected to come off, right? So at the moment we're what, about 6.5 we just saw. So even if this, right, is suggesting that GDP is now going to fall, you can see the last GDP reading here. This is a leading indicator, remember, data collected August 12th to 20th. And by the way, for any of you young guys watching this who want to get into investment banking, this stuff is gold. Okay, you talk about this stuff when you are trying to get one of the top jobs working on a trading floor in a bank. They are going to be like, they're going to be like putty in your hands, right? These guys are going to be like, this guy understands the market, okay? You start talking about squiggly lines and Fibonacci's and garbage, okay? They're not going to be interested. This is the stuff, and it's not hard to research. You can watch this video and it's obviously all here for you. This is the stuff that drives markets, and this is what incredibly important investors are looking at. They're trying to gauge where is economic growth going to be going forward, okay? And if we have a leading indicator telling us that, that's what we need to look at. So my point is, even though, yes, the composite PMI has come off, suggesting GDP is also going to now come off, it's expected, right? You can't have GDP of 6% forever. The economy would overheat, inflation would spiral out of control, it would be a recipe for disaster, okay? So GDP coming back down to 2 or 3% is very, very healthy, and I think long-term average in the US is around 3.5%, so fine, very strong numbers, and you saw how the market reacted, very, very happy. There was also, let's move on to COVID during the week, some figures coming out. There was also talk of a new vaccine being approved by the FDA, which is safe for all over 16s, which suggests that a lot of employers could be mandating now vaccines, which should help this rate drop off. Now you might be saying, hang on, that's high, 155,000. It is, and it is the highest since January. So here, January, where are we here? Okay, so it's the highest since January. That's correct, and I'll show you, it's actually started to slow down now. So there's a hope that this starts to now turn. Okay. That's basically how the market's been reading this number, and I'll show you the month on month, which will present this much clearer. Okay, there you go. Can you see it? The month on month has actually started to tail off now. Sorry, the week on week, I beg your pardon, the week over week. So the week over week change has actually slowed down to around 6%, right? It was going exponential here. You can see early part of kind of July, August, right? Which you can see here. You see that? June, July, August, right? Growing at almost 80% week on week. Now it's all the way down at 60%, which you can see here with the tail off. So that was taken very positive, in addition to obviously the two bits of news I think there were about vaccines. One was there was a new vaccine approved by the FDA for use in the US. This vaccine probably already been used elsewhere, but it wasn't approved for use for over 16s in the US, which it has been. And also a lot of talk about booster jabs being now, the third jab. You've had two and there's a third one, because obviously the efficacy or the effectiveness does wane after some time of those two jabs. So there is that. So very positive kind of Delta variant news the market took that as. Whether that remains to be seen, we shall see, right? If this starts to turn negative, then that's great. If it starts to go positive again, then obviously that's bad news, and we'll see that hopefully in some of the economic data spilling through. Payroll will be very interesting because of this as well. So we know there's a payroll number, albeit it's with a 1 month lag. There will be a payroll number coming out next week on Friday, so something to watch for. And then finally, like I said, just a bit of a rush today. I want to go over Fed Powell, Chairman Powell's comments during Jackson Hole. So basically this was taken very positively. It wasn't anywhere near as hawkish as expected. There was a bit of a fear because the week before, because some other Federal Reserve members, I talked about it last week, have been kind of pushing for early tapering, right? So kind of September, October. But Chairman Powell made it clear that it was more likely to be towards the end of the year. He also made a comment which I think is what really boosted the market, where he made it clear that tapering and interest rate hikes are going to be treated completely different by the Federal Reserve. So they're not interested in hiking rates. When they start tapering, they got completely different stress tests needed for them to think about raising rates. So there'll be much more stringent tests, and you see that here. So I'm telling you all of this because I'm going to read word for word what he said, but I'm trying to just translate it for you. So timing and pace of the coming reduction in asset purchases, tapering, will not be intended to carry a direct signal regarding the timing of interest rate liftoff, interest rate changes. So can you see he's letting the market know that just because we start tapering, we're not going to start raising rates, for which we have articulated a different and substantially more stringent test. Okay, so basically that's very dovish, right? They want to see a lot more in terms of strength. You could argue there's been so much, but whatever. Obviously that is a clear sign that the Fed wants to see a lot more economic recovery before they even think about raising interest rates. Okay, so that's obviously boosted the value of assets, including equities. And he also said we have much ground to cover to reach maximum employment. So again, pegging on that employment data, being very kind of careful about employment, even though we've seen employment numbers being very strong, non-committal to even the most recent jobs data reports. So I think they'll want to see another couple, basically. There'll be one again this Friday. I don't think it's going to be enough for them to make any decision. It's definitely going to be this year, I think, where they start to taper, but they're going to want to see at least 2 more jobs reports. So I've been saying this all along, right? We're looking at sort of towards the end of the year, kind of November time, I think, not as early as September. So 2 things here to note. One is the market is now no longer nervous about tapering starting earlier. They're happy with, they know, look, people who trade, they recognize you can't have this asset buying policy so aggressively forever. It can start to have negative impact on the economy. So they're expecting tapering to happen. That won't necessarily be a negative, it's the timing. They don't want it to be pulled too soon. The Fed is kind of aligned with the market now, where it is saying we're not going to do it too soon, we're not going to do it in a month's time, we might wait 2 or 3 months. So that's been taken positively. Basically, no deviation from what they've been saying so far. And then number 2 is interest rate hikes. Okay, IRH, interest rate hikes. Fed has made it clear that they're 2 separate matters. And to me, that means interest rate hikes are not happening this year. That was taken incredibly positively. So you can see it still sees interest rate, don't know what that says because I can't see, hikes off in the distance. That's why we rallied so hard. New all-time highs on Friday. Hopefully that's clear. Right, we're almost done now. Next week, what have we got? Nothing much on Monday. We've got pending home sales. I don't think the market's really going to be that interested in any of these numbers early on. We've got OPEC, obviously more important for crude oil. ADP will kind of give a signal as to likely what. Basically, in a nutshell, everything's going to be around the Friday payrolls number. Right, and ahead of Friday, we might get some early indication how strong this number is going to be. And I say strong because it is going to be strong. Most likely, unemployment's likely to tick down again, 5.2%. ADP will give us an idea. We're forecasting 650, almost double what the previous was. So Wednesday, we might see some volatility. Monday, Tuesday, I'm not expecting much. I'm expecting kind of sideways. We'll see what happens. Wednesday, a little bit of volatility, and then going into the Thursday, Friday will give me an indication how to trade the week. And I think that's going to be the main thing. I don't think any of the manufacturing or services PMIs are going to be that closely watched, because I think we're just going to see much of the same. So really, it's all about payrolls. Obviously, in terms of potential volatility, there is that risk we've got with the geopolitical headlines, right? Afghanistan, and obviously there's a little bit of tension still going on there. The COVID numbers, which I talked about. So, you know, it's okay if you go into it a little bit weary this week, because like I said, seasonals, September's always been the weakest generally over the last 100 years. So I think there are some COVID and seasonal risks there. Last week I expected the market to be sideways to negative. We ended up rallying. Did it matter? No, I still made a lot of money last week, and I'll show you, right? Okay. Fact. Have I got it here? No, I don't. I don't actually have it. I'm sorry about that. Don't have the week to date performance, which was 5,000. Right, sorry about that. I had to just pull it up very, very quickly so you can see here this week. This is just this week. So Monday 1600, Tuesday 1800, Wednesday 1075. So for the week, just shy of $5,000. So that was last week. And then this is basically for the month 31,500, which is pretty much done. So my point is that even though last week I had, you could say, slightly, not heavily negative, but slightly sideways to negative because of the seasonals and the risks that I've mentioned here, the COVID and the geopolitical risks, that the point is I kind of just waited and saw what the market was doing, and it became clear on Monday and Tuesday that there was no interest. There was short squeezing going on, which is why I ended up basically buying the market regardless. So even though this week, again, I do have a short bias to sideways bias, I'll see how Monday, Tuesday go and then decide from there. Hopefully that was useful. I will quickly show you this because I don't like to just do screenshots, obviously. I'll show you this 31,512.50 in my live account, and then we'll be done for the week. In fact, I can probably just drag it down rather than having to cut and then cut back. So yeah, there you go. You can see my this is my Sierra chart that I use. Everyone knows the footprint that you should be using. If you're not using, check out some of my other videos if you want to know all about the footprint. Sorry, that's the trade activity log. Okay, so trade activity log. My live account, right, which I show openly, non-sim account number 31,512.50, which you can see here. Okay, long trades 29,475, short trades 2,037, and profit factor 4.63. I will actually, maybe if I get time, do another video on this. But yeah, if you want to obviously check out footprint, all the stuff I do in more detail, don't forget you can check all of that out. I've got a free training at www.g7fxfreetraining.com. You can also follow me on Instagram at NVForex. Don't forget to like and subscribe to the channel. Hopefully that was useful. I'll see you either during the week or another Institutional Sunday. Have a great week, guys.